Do you ever feel like you're looking at a loan estimate and you're like Neo in the Matrix trying to figure out some of these numbers, or just the complete opposite of Neo? Well, we are here today to be able to walk you through the customer information sheet of the loan estimate sheet. And, Neo, female Neo right here, can actually go through and read some of these numbers for you.
Yeah, so basically what a loan estimate is, it's a document that you can get after pre-qualification that shows you the potential breakdown of costs associated with a mortgage. These numbers typically get firmed up throughout the process as things are gathered. Once you go under contract, we'll firm up property taxes and homeowners insurance. Once the appraisal comes in, we'll firm up the appraisal costs. Once title work comes in, we'll update those numbers accordingly. So as these invoices come in and these jobs are being done, we update the numbers along the way to help our clients stay informed about their total out-of-pocket costs that's due at closing.
So, some of the things that end up popping up, you'll have some things that can change and some things that don't change, correct?
Yes.
On the loan estimate?
Yeah. Mm-hmm.
So that's essentially what they end up talking to. There's a lot of things to be able to navigate. And one thing I've always, loved about working with Tracey is that she does a lot of this homework up front so you can get a more accurate number. If you're kind of mailing it in on the front end and doing some estimates, your payment can actually vary quite a bit based on those items that can change, right? Like insurance, all that other fun stuff.
Exactly.
So insurance and escrows and property taxes. Mm-hmm. So making sure that sets up. So what we're going to do right here, we're going to put up a loan estimate sheet and pop it all up here.
All right. Okay, awesome. Got it. Okay. So if you look at this is a purchase price of $95,000. I used a rural development loan in this example for a few different reasons. Rural development is up to 100% financing. That just means that you may not have to come to closing with a down payment. That doesn't necessarily mean that you don't have to come to closing with closing costs. So I'll go through all of that in a bit, but an RD loan is a 30-year fixed. We're using an example interest rate of 5.875. If you look at top left box, estimated monthly payment, you'll see the payment breakdown. So you'll have principal and interest. Hazard insurance is home insurance. Okay, that trips a lot of people up. That's just the universal language for home insurance throughout the country. Flood insurance, if the home is in a flood zone that requires flood insurance, that would be listed there. Property taxes based on the area that this particular home was in. Rural development has a monthly RD fee that gets, and I see that double. You see that? Okay, yep. That's a goof. So ignore that. Rural development has monthly mortgage insurance. So anytime you buy a house and you don't put at least 20% down, you're going to have to pay mortgage insurance or PMI. So on rural development, what's unique is every 12 months, that amount decreases until it whittles away into nothing. But rural development has the lowest mortgage insurance of almost any product, especially if at 100% financing, this is the lowest you can get. Their rate is lowest.
Super cool. So just for those that mentioned, there's a wind and hail at 2783. That one's actually, that should be removed. So it's actually going to drop.
Yeah, sorry about that. Ignore that. Something doubled in here. So, $750 loan amount, total loan amount for this example. So we talked about fees that don't really change. So if you go down and you look at the lender fees, that's going to be your underwriting, admin, doc prep. So that right under $1,500 cost is what the bank charges as a flat fee to do all of the things that we need to do. Appraisal costs will vary anywhere from about $500 to $600, depending on the loan product and the location of the property. Credit report fee, flood cert to pull a flood cert, and then RD has their little fee. If you look over to the right where you see prepaid, so days of interest. This is determined by the day of the month you close. So if you close at the beginning of the month, you have more days of prepaid interest to pay. If you close at the end of the month, you have fewer days to pay. The reason you pay interest in advance is because you pay the mortgage in arrears. So let's say this client goes under contract today, She closes in November. She has no monthly payment in November, no monthly payment in December. Her first monthly payment will be due January 1, always due to be paid by the 15th. So that's why you have to pay days of interest in advance. The mortgage insurance premium, I'll get to that at the bottom. So let's skip that for now.
I actually want to kind of pop in. And one of the things that you hear a good bit from agents and lenders is it's cheaper to close at the end of the month. And, you know, this is kind of piggybacking off what she talked about. It's not necessarily cheaper. You're going to either spend less money at the end of by closing at the end of the month,
or you're going to delay it.
Or you're going to delay your payment. So at the end of the day, the bank's going to get their money. They're not, you know, they're the bank for a reason. They make the money for a reason. We're not outsmarting it, but it can lessen the amount out of pocket that needs to happen. Or if you want to have a little bit more space in between the time you close until your next payment, that kind of depends on, you know, the time of month that you close.
Right. Okay, so then you have your insurance premiums. You have homeowners insurance. The estimate on this property was $1,500 a year, and the flood insurance estimate was $480 a year. So these premiums go directly to the insurance company right after closing to pay those premiums. This and escrow, which you'll see right below, is typically what trips people up as well. Why am I putting 12 months plus another 2 or 3 months in escrow? This is why. Goes back to when you close and when you start paying. So immediately, whenever you close on the property, that home needs insurance. So that insurance gets paid immediately so that the property is insured. You're not accruing those 1/12 of the tax, flood, and insurance payments until you start making those monthly payments. So for this particular example, you wouldn't start accruing the funds needed to pay next year's home, flood, and taxes until January. So this one gives you a cushion if and when taxes and insurance go up, and we both know taxes and insurance never go down. And it also ensures that when these bills come due next year, at the end of the year, you should have enough in that escrow account to pay those bills on your behalf. So what happens is the lender will send you the statement for all three of these, but they will I'm saying the lender, the service, the tax assessor and the insurance company will send you these statements, but they will send the bill to your mortgage company. So when they send the bill to the mortgage company is responsible for paying said bills on your behalf. Okay. So if we go down to reserves, this is setting up those escrow accounts we just spoke about for home insurance, property taxes, and flood insurance. Okay. Depending on the month of the year you close, that's what dictates how many months of taxes you put in there. And on average, you'll put anywhere from 2 to 3 months in escrow for home and flood insurance. If we go down a little bit to title and closing fees and then continue that into the next page, so if you can keep scrolling down. Okay. No, stay back up. Yes, stop. No. Up. Stop. Okay.
Well, what's happening is they don't see what you're seeing right here.
No. That's
and this is what I'm trying
Okay.
to
All right. Go to the next page then. Okay. So the bottom of the first page, bottom right corner, and then the rest of, that, and then the rest of the next page or estimates for title fees. So we have to hire a title attorney who researches you, the property, the seller, just to make sure that title work is clean, there are no liens on title, and that there are no issues with said property, so that when you acquire it and we acquire it as a lien holder, there hopefully are no issues. Now, if there are issues that are discovered after closing, that's where the owners and lenders title insurance policies come into effect. This could potentially help you if and when there was a defect on title that the title company did not find or came up later. That could help save you a lot of stress and issues. And we won't get into all that. That's a whole other big conversation. If you scroll down to the bottom left, you'll see recording fees. So recordation varies depending on the parish. This will cost anywhere from about $250 to $400. It also varies depending on the number of pages that have to get recorded, because all the different loan products have different amounts of pages that have to get recorded. So we go to the bottom, estimated funds needed to close. purchase price is $95,000. It's 100% financing. Closing cost, $4,607. Reserves, prepaids. Remember, this is your prepaid interest that we talked about. This is taxes and insurance for escrow and then paying those premiums in advance. And FHA, RD, and VA all have what's called a funding fee. This gets financed into the loan and spread out over the 30-year term. So it has a very low impact on your monthly payment. So then you'll see at the very bottom, if the seller pays no closing costs, if the lender pays no closing costs, total estimated cash from borrower is $73.76. Now, I had a conversation with the dad who's helping his daughter buy a house yesterday. And we went through this. This is the same loan estimate I went through with them. And he said, what are these junk fees? And I said, tell me what you mean by that. And he meant the mortgage insurance per month, or the PMI for RD, and the funding fee. And my question to him was, when's the last time you bought and financed a house? And it had been a very long time. And I said, how much did you have to put down when you bought that house? He said, oh, at least 20%. I said, aha. I said, back in the day when you bought your house, there was no other option. There was no 100% financing that your daughter needs. I said, there was only, you have to put 20% down, and guess what? You don't buy a house. So what happened? All these different products and mortgage insurance companies popped up and said, hey, you know what? We will back and insure the loan again for, in case of default for the investor if you allow your clients to buy a home with less than 20% down.
Ta-da.
And once I said that, he's like, okay, that makes sense.
That's no longer junk.
Yeah. Something else that's really cool about RD, and again, this is a whole other topic, but if the home appraises for, let's say, $100,000 instead of $95,000, and if the borrower wants and qualifies for that higher mortgage payment, you can roll in the difference in closing costs. So at that point, you could increase your purchase price from $95,000 to $100,000 without having to update the contract or let the seller know. And then at that point, you'd roll in $5,000 in closing costs, and that would have you come into closing with $23.76 instead of $73.76.
That's super cool. So a couple of things that I hear from buyers whenever they're going and looking at these fee sheets. One of the biggest mistakes that they do is they look straight to the bottom at $73.76. And that's, oh my gosh, that's the closing cost. No, it's not. Part of that is your insurance and your property taxes. And those are things, if you really are trying to save some money, that you get dialed in, get multiple quotes on your insurance. If you have some questions about that, we can definitely go and work with you on that and give you a couple of names to go and shop that stuff out. Side note, you want to make sure that you're not under-insuring yourself for the property, because just because it's a lower payment doesn't mean that it's better. So that's that's probably another topic for some other things. Yeah. Another one, we'll jump back. I do want to go back to page 1, because one of the things that also pops up when people are rate shopping, they're like, oh my gosh, I got, in this case, we were at a 5.875, and, maybe some pocket mortgage can beat it by 0.25 points. And, typically, and Tracey probably cut me off right here. Usually if there's going to be a little bit cheaper, the devil's in the details and some of the costs. So what are some of the hidden tricks and tips that some lenders are using? So
somebody's offering you a crazy low rate, like ask them what the cost is for the rate, because at that point, anybody can give you just about any rate out there. But it comes at a cost to you as the consumer or the buyer. So let's say someone's offering a 1/4 point lower for this exact same scenario. Chances are you're paying for it via a discount fee, discount point, or loan origination fee. So it's fine if you're educated on that and if it makes sense for you to do that, but it doesn't make sense for every client. So at that point, if you're getting quoted a rate that seems really low and maybe too good to be true, I would immediately ask for a detailed loan estimate so that you can look at it and figure out what the cost is for that rate, because I can almost guarantee you that there's a cost for the rate. And you're going to see all these advertisements about, oh yes, get our 5% rate and this, that, and the other. There's something behind that. And if you want the something behind that, great, but it doesn't always make sense for every single buyer.
So we're going to do a quick little scenario right here. If let's say the quarter of a point cost you, in this scenario, what it would be like,
I don't know,
$1,500, $2,000. One of the ways to be able to go and check some of these things out is to do a break-even return. So, and I like to use round numbers because this won't necessarily make it make sense. But let's say your origination, well, let's just do 1%. So that would be $950, and it saves you $7 a month. That's both of these numbers are made up kind of on the spot, just like 60% of statistics. So if you're saving $7 over not the cost of $950, your break even is 135 months, or we go and knock that into years. It take not 102. Come on, let's see. What was it? 135 divided by 12. That takes you 11 and a quarter years before you're actually in the red. So it doesn't necessarily always are out of the red. You have to make sure that in order to be able to, let's see, let me go pop our.
You need to figure out how long you're going to own the property. So if you don't plan on owning that property for over 11 years, it does not make sense for you to do this.
Correct.
Because you've spent the money. So
yeah, once it's gone, it's gone.
Yeah.
So just because it's a better rate doesn't necessarily mean you need to pay for it.
It doesn't mean it's a better scenario for you.
Lots of things to be able to go and jump in. I know this is a ton of information, but if you really want to get down and dirty onto the equity position and what your loan costs look like, even if you have to compare to what Tracey has over at Hancock Whitney, we're happy to be able to do that and be able to put these things side by side. That could be a fun podcast too, to show where some of the costs could be, what you could look for. Pro tip to be able to look for some of those things that, where are the costs and why one decision could be worse than the other, even if the rate is a little bit lower. So, Tracey, where can they find you?
337-257-9146.
We'll see you next week.